Hey guys, welcome back to another video on market research lessons. For all of you guys who have watched my previous video and already know, or for some of you this is your first time watching my video, I have just created a new playlist on market research lessons. In this playlist, I share with you the market research lessons that I learned from the market research themselves who are interviewed in Jack Schwager's book. So in this market research lessons video, I'll be sharing with you the lessons that I learned from Bruce Kovner. These are some of the achievements that Bruce Kovner managed to achieve in the stock market. From 1978 to 1987, he managed to achieve an 87% average annual compounded return. So with that kind of returns in the stock market, $2,000 invested with him would turn to $1 million just 10 years later. So there are definitely a lot of things that we can learn from Bruce Kovner. These are the 5 lessons from Bruce Kovner. The first is fundamental plus technical analysis. The second is position sizing and stop losses. The third is risk management and correlation of trades. The fourth, on losing. And the fifth, traits of a good trader. So now let's take a look at these individual lessons. The first lesson from Bruce Kovner is fundamental plus technical analysis. He uses both fundamental and technical analysis to confirm his view of the markets. And he always uses them hand in hand. So the fundamental and the technical analysis will complement one another. So for most of Bruce Kovner's trades, he wants his fundamental analysis to confirm his technical analysis and his technical analysis to confirm his fundamental analysis. But in some instances, if a market reaches a point where there's a major change in fundamentals and he's not sure which direction the market will go, he will pay attention to the technicals first, because he believes that the initial direction of the market move is often a good tip-off of the longer term trend. So an example that Bruce Kovner gave was his trade on the Canadian dollar. Back when he was trading on the Canadian dollar reached a point where there's a major change in fundamentals. And this was due to the US-Canadian trade pact. But although at the time, even though Bruce Kovner knew that there was a major change in fundamentals coming up for the Canadian dollar, he wasn't sure which direction the Canadian dollar would go to. So instead, he paid attention first to the technicals and followed that direction even before he knew all of the fundamentals. Those are some instances that Bruce Kovner allowed technical analysis to lead him before the fundamentals. But take note, he already knew that there was a major change in fundamentals coming up. He just wasn't sure of which direction that the market will head to. The second lesson from Bruce Kovner is position sizing and stop losses. He mentions that we must be disciplined enough to take the right position size consistently. And position size is determined by stop losses, and the stop is determined on a technical basis. So how do we set stop losses? According to Bruce Kovner, we want to place our stops beyond a technical barrier. And a technical barrier is an area that the market shouldn't go if you are right. So for example, if you have a position in the market and you believe that the market is likely to go up in the future, and you bought your position in at around $100, and you know that if the market falls below $90, then you are wrong about your investment thesis. Then the technical barrier for your position is at around $90, because this is an area that the market shouldn't go if you are right. So that's how Bruce Kovner set his stop losses in the market. And a very important point is this: placing your stop losses at the right technical area is more important than the number of positions you plan to take. For many traders, they set their stop losses based on the number of positions they plan to take. For example, if they plan to take on 100 positions in that particular trade, they might move their stop losses closer to the price point which they enter their position at, so that they still meet their position sizing criteria. So they are placing more importance on the number of positions that they take instead of placing their stops at the right technical area. But according to Bruce Kovner, they are getting their priorities wrong. Bruce Kovner believed that we should prioritize placing our stop at the right technical area over the number of positions that we plan to take. If the right technical area is very far away from our entry point, then he suggests that we reduce the number of positions that we plan to take to meet our position sizing criteria. And for the third lesson, it is about risk management and correlation. Bruce Kovner believed that we should only take 1 to 2% risk per trade. And he's talking about the overall exposure to that one trade idea rather than that position itself. So even if you have different trade positions, but if they are related to the same trade idea, this means that there's correlation among your trades. And this might result you in being over leveraged on a particular trade. So as a trader, even though we might follow the proper risk management techniques, sometimes we might overlook the correlation between our own trades. And if we overlook this correlation, we might be over leveraged and be exposing ourselves to greater risk in the markets. So that's the third lesson from Bruce Kovner: proper risk management and paying attention to the correlation between our trades. The fourth lesson is on losing. In the stock market, we are bound to always make mistakes because there are always new things to learn. Losing the stock market will be a constant affair. And this is what Bruce Kovner has to say on losing. He mentions that we have to be willing to make mistakes regularly and we shouldn't personalize the losses because there are investors and traders out there who believe that the market is going against them. Some sort of like a personal nemesis. But Bruce Kovner said that the market doesn't care whether you make money or not. So you shouldn't personalize your losses in the stock market. Because once you personalize the losses, you might want to revenge trade. And revenge trading is one of the surest way to lose money in the stock market. The fifth lesson from Bruce Kovner is his thoughts on what makes a good trader. He believes that good traders are strong and independent. Because to make money, we have to hold a position with conviction. If we are not strong and independent, we might be easily influenced by the opinions of others. And when the opinions of others goes against our own trade ideas, if we are not strong and independent, we might give up on our own trade ideas. And thus we won't be able to hold our position with conviction. On top of being strong and independent, Bruce Kovner also mentioned that we need to have the discipline and willingness to make and accept mistakes. As I mentioned earlier on, there are always new things to learn in the stock market. So if there are constantly new things to learn about the stock market, we'll definitely make mistakes from time to time. So a good trader will have the discipline and willingness to accept and make mistakes in the stock market. And that is how we continuously learn and grow in the stock market. Those are the 5 market research lessons from Bruce Kovner. If you want to be the first to be notified of these new videos coming to this new playlist, make sure you subscribe to my channel and turn on the notification bell button. I'll see you in those other videos. To your financial success.